You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
But if you take a look at silver's still a little less than $20 away from its all-time high of $50, but its inflation-adjusted all-time high is around $120 when silver reached around $50 back in 1980. So I think the smart money is seeing the opportunity in these silver stocks, A, because silver has a lot of catching up to do with the gold price, and B, because there's really not a lot of quality silver juniors out there.
I'm Bill Powers, and you're listening to MSE. Thank you for tuning in. In today's show, you will hear from Dr. David Erfle from Junior Miner Junkie with a Y.com for our monthly check-in on the show. Dave, thanks for coming back on. It was great to see you a month ago at the Beaver Creek Precious Metals Summit. Let's start with your gold commentary. Gold continues to go up. When I look at that 6-month chart, it's just up and away. What is your commentary on the gold price, please?
Yeah, it's really interesting the way the gold market's playing out here. It just keeps going higher. And, the gold price ran up to a little over $2,700. And then it had a healthy $80 correction for about 4 or 5 days. But then U.S. inflation data that came out was deemed pretty friendly for the gold price and basically unlikely to change the trajectory of the easier Federal Reserve monetary policy, even despite the fact that they pretty much caved on inflation. The CPI that's come out is still well over 3%. If you take out, even if you take out the volatile food and energy, which we all eat and we all buy gas and we all need energy. The inflation rate is still well above 2%, but the Fed is having to cave on that, and they started off with a 50 basis point cut, which is almost like an emergency cut after keeping rates unchanged for a year. So that basically is telling the gold price danger, Will Robinson, and I think it's because of the debt. The debt that keeps rising exponentially higher. I mean, the debt. I think on the very first day of the fiscal year, on a few Tuesdays ago, the debt went up $204 billion on the very first day. So the Fed needs to lower rates because it's the interest payments that is making it so untenable. Over 70% is a cumulative interest rates on the 30s, almost $36 trillion national debt now. And then there's the unfunded liabilities, which is over $100 trillion. I mean, it's just crazy. And the gold price sees that, hey, there's no intention and there's no way of ever paying any of this off. So it's going to continue to go higher. If you just look at the debt and the gold price, it's rising in lockstep, and they come out and they say, we've suspended the so-called debt ceiling, which is ridiculous. There is no debt ceiling. It continues to climb. So the gold price is going up on that. The gold price is going up on what's going on in the Middle East, what's going on in Ukraine, this chaotic U.S. election that, once we have a result on November 5th, we don't even know if we're going to have a result. I know because both sides are screaming that each candidate has, the Republicans are basically saying that the Democratic candidate is illegitimate because she was basically appointed. And then on the other side, the Democrats are saying that the Republican candidate is a felon. He's been convicted of a crime, so he should not be eligible to be president. So I wouldn't even be surprised if the result winds up in the Supreme Court. So we've got all that going on, and the gold price is sensing this, and it just continues to go higher. Each time there's a dip, it continues to be bought.
Is there anything that could happen from a macroeconomic standpoint, or you brought in politics as well and the uncertainty that's there? Is there anything that could happen that could change your mind regarding a bullish perspective on the gold juniors?
Peace breaking out, in the Middle East, the Ukraine Russia war ending, all of a sudden the debt problems go away. I mean, I don't see anything that's going to hold back the gold price here. I wouldn't be surprised to see gold reach $2,800 or over by the time the U.S. election takes place, which is in 3 weeks' time.
What about silver? Silver's at $31 an ounce. I've heard people say as soon as we break through 30, straight shot to $37, $38 an ounce. We haven't seen that yet. What do you see happening in the silver price?
Yeah, the silver price, it's really interesting, Bill, what's going on with silver. If you take a look at the GDX and the GDXJ, which are the gold ETFs, even though we saw GDX make an 11-year quarterly high a couple of weeks ago, GDX and GDXJ last week did not make a 52-week high. They came close, but they did not. And as a matter of fact, if you take a look at both GDX and GDXJ, they've been building out this really bullish bull flag right at strong multi-year resistance. So what's strong multi-year resistance? It's building a bull flag to eventually become a floor. And that bull flag attempted to break down last week. It was a false breakdown. So by the end of the week, when the gold price turned around, so did the shares. So there's still, GDX is consolidating around 40, GDXJ is consolidating around 49. But if you take a look at SIL and SILJ, those are the two silver ETFs. They both made 52-week highs last week, and they're consolidating with a bullish bias on an upward bias. So it's really interesting because you see the silver price has lately begun to lag the gold price again. I mean, it's 32.50 is that Maginot line of resistance for silver on a weekly price basis. 32.50, it can't get over 32.50. So the silver price is consolidating in a larger range between like 29 and 32.50, 33. And the gold price is consolidating in a higher range between just around 26.50 and 2700. So it's really interesting how this is playing out, because I think the smart money sees that the potential in silver. I mean, the gold price now is right around its inflation adjusted all-time high, which was set back 45 years ago when the gold price ran up to 850, 875. The gold price had yet to reach that price level on an inflation adjusted CPI basis, and it's right around there right now. But if you take a look at silver, silver's still a little less than $20 away from its all-time high of $50, but its inflation adjusted all-time high is around $120 when silver reached around $50 back in 1980. So I think the smart money is seeing the opportunity in these silver stocks, A, because silver has a lot of catching up to do with the gold price, and B, because there's really not a lot of quality silver juniors out there. So I think that they're concentrating on the quality silver juniors right now.
Okay, with this perspective, smart money looking at the quality silver juniors, is this what First Majestic and Core Mining have done, in which First Majestic acquired Gatos a little over a month ago, and then Core acquired Silvercrest? Is that part of what's going on too, related to what you're talking about, Dave?
Yeah, because you see what's happening in the mining space. We need more consolidation, and at the same time, these majors, they need more ounces in the ground, because they've concentrated on their balance sheets over the past 10 years, and their balance sheets are very healthy now. They're even paying dividends. I mean, when I got into this space over 20 years ago, it was unheard of that miners paid dividends, and now they're paying dividends, and now they have really strong balance sheets. So the next step is they got to concentrate on adding more ounces in the ground. So, and as far as silver is concerned, there's just a handful of quality silver projects out there, especially primary silver deposits. There's not that many. So recently we've had a couple. We saw First Majestic take over Gatos, and then a couple weeks ago we saw Coeur d'Alene make an offer for Silvercrest. So basically these companies now, I mean, these investors now are wondering what's the next growth-oriented producer to be taken out, or what's the next late stage junior that is de-risking a large quality deposit with upside potential in a favorable jurisdiction. Investors are basically looking, okay, what's the next company that what are the next companies we should be getting into that are takeover candidates? So that's why you see several of these quality juniors have been bifurcating. They've been going higher with the GDX and GDXJ, while some of the other optionality plays in the junior developer space, they've yet to move very much, because either they don't have the access to capital, or if they do have the access to capital, they've been able to raise money, but their projects are still 2, 3, 4 years away from being fully permitted. I mean, while you see the gold price touching up against $2,700 an ounce, a lot of these companies are still trading for less than $40 an ounce gold in the ground. I mean, if you take a look at the dichotomy, it's pretty crazy between what happened during the last bull market, when we had a blow off top in the last bull market, where companies were being taken out for $1,000, $1,200 an ounce in the ground. And now the gold price is $800 higher than back then in 2010, 2011. Yet these juniors are trading at $40 and less an ounce in the ground. Some of them are trading at even $10, less than $10 an ounce in the ground, and their cost to discover the gold ounces are 7 to 10, and that's what they're trading for, despite the fact that the gold price is close to $2,700 an ounce.
So Dave, you said previously on the show in recent months that you were focusing on quality ounces in the ground. Now, you just laid out that some of those quality ounces are beginning to bifurcate. So with the way the stocks work in a gold upcycle is the royalty companies move, the big producers move, the smaller producers move, some of the quality ounces in the ground developers begin to move. So if they begin to move, are you looking down further the qualitative chain here within the gold stocks?
Well, if you're talking about higher risk early stage companies,
it doesn't, or lesser quality ounces in the ground that would move perhaps even before the Explorcos would move in terms of share price.
Oh, you're
performance.
talking about You're talking about optionality.
It doesn't need to be, a full International Tower Hill Mines or something like that. It could be something a little better.
Right. I've got several of those already in my portfolio. So not really. But the company that I recently announced, recommended to my subscribers to purchase, because basically what I do is I write up a full report on a company and send it out to my subscribers ahead of time and tell them this is a new company that I recommend that I'll be buying shares in next week. That's how I do it. And the company that I did that recently with just put out a fantastic PEA, and so they're at the feasibility stage now. So companies that are at the feasibility stage that just put out a PEA, I like that subsector right now, because I think that these companies have a good chance of attracting a major to be a strategic partner. And if the market sees that, they see that a company's put out this very attractive PEA, they've got enough capital, but they're going to need more capital, of course, to de-risk to the feasibility stage, that they'll probably attract a strategic partner in a major or a mid-tier. And if they're successful in doing that, the stock price will really start to re-rate. I did that recently with another company that announced a PEA. I really liked the PEA, and I had it on my watch list. I was following it really closely, and then a major did a strategic placement with a major, and the stock took off. So as soon as they announced that strategic placement, I announced a recommendation to buy the stock and bought the stock myself to my subscribers, and the stock has done really well since. So this company that I recently recommended and then I purchased a half position in, I think they're set up to attract a major, and I think they'll do the same thing. And if you look at the stock price, it's created this really strong bottom. It's got this inverse head and shoulders bottom, and it's just waiting for a trigger to explode.
When you see a major producer invest in a PEA stage, which is an earlier development stage company, what means more to you? Like the technical approval or the technical qualitative stamp? Like, yes, we see something here, or is it the cash injection?
Oh, it's both. Because when you get a strategic partner like that, you have access to their technical expertise as well, and especially if they make a further announcement of future deals that the company will be participating in. That basically says that, hey, this major is fully on board with this, not only this project, but this company. And there's a really good chance that eventually they'll take out the entire company, and hopefully for a lot more than you just paid for it by getting in for that reason. So, this is where we see the multiple gains in these juniors. Things like this, where you basically have the major or the junior quantify the project and say, look, this project is very attractive, and we're going to back you because we feel that there's a lot of upside potential, not only in this deposit, in this project, but in this company, because they're doing the right things in de-risking it.
When you're looking at a development company and their metallurgical flow sheet is too complex, Dave, is that a red flag for you? Or what happens if they're implementing some sort of new type of process or technology as part of how they're going to extract the minerals? Are those red flags for you, or would you be willing to look at something like that?
Since I'm not a geologist, that's where I basically send out emails to colleagues and friends and that are geologists and say, what does this mean? What does this look like to you? Is this a red flag, or is this really something promising? Is this new process that they're going to be using? Is it legitimate, and is it something that's going to help the project?
Mm-hmm. But even times when we rely on others, because I do that too with my Rolodex. Like years ago, I was told not to invest in Great Bear because I was told so-and-so looked at it and they took a pass. Therefore, Bill, don't waste your time because you can't figure it out better than they can. So
that's why you get more than one opinion.
And then sometimes people have told me not to invest. I did anyway. And in Beaver Creek, I was reminding somebody, remember when you told me not to invest? Yeah, this is how much I lost in that.
Oh, yeah, absolutely. Absolutely. I mean, it's funny, these things, a lot of these companies that you invest in, some of them, they look like, okay, this one ticks every single box. I'm going to load up on this stock. I'm going to go big on it. I always resist the temptation to put any more than 5% of my investment capital into one company because of that, because anything can go wrong at any time with any of these juniors and their projects. There's so much that can go wrong. Not everything has to go right, but most everything has to go right for you to make money, and only one major thing can go wrong for you to lose money. So that's what makes it so challenging, and that's what makes it so fun, because when you do get that multi-bagger, it's very satisfying because all the work you put into it to get there, and all the investment capital that you've risked with other companies that didn't do so well, it's paid off because this one did so well, and it's covered the losses that you have in some of the other holdings.
But in your retirement non-speculative account, you'll take bigger positions than 5% only, right?
Because they're very low risk companies. That in my retirement account, I only invest in miners and royalty companies in the big boys that I see that I see 2 or 3 times gains instead of 3 to 10 times gains in juniors. The higher risk, the higher reward. But it's funny because before 2023, I never even invested in majors because I there's not enough upside in the majors for me to be attracted to them. But in 2023, when I saw how ridiculously cheap they'd gotten, I took positions in my retirement account for the first time in miners because they were just, the upside potential was so huge and the downside risk potential was so low. I couldn't help myself, and it's a good thing I did, because that portfolio has been doing better than the junior portfolio over the past couple of years.
Which begs the question, why are we in the juniors? At least for the last couple of years, right?
That potential, right? It's still there.
It's luring.
And we're just, right. And we're just waiting for the general public to wake up and stop overpaying for these overpriced AI stocks and
come overpay for my junior miners, right?
Come into this junior miner sector that's been ignored by you for the past decade, that is trading at just unbelievably low prices in comparison to the gold price, that the risk is just so low. And a lot of these juniors, even the ones that have been shellacked over the last few years, they're even creating solid bottoms, and a lot of them are that still have that access to capital. The upside potential is a little less because they've had to dilute at lower prices, but the projects are still good and the upside potential is still there. There's just not as much of it there.
Dave, I've heard you say a lot this year that investors are smarter in junior mining stocks right now, and we don't see dumb money coming in to bail out our mistakes, right? But do you think that with every upcycle in junior mining, gold junior stocks in particular, that it requires the mad rush of dumb money for it to make it worth it for you and me, who focus more on this sector on a day-by-day basis?
Absolutely. I mean, we definitely need it and we need it right now to bail us out of some of our mistakes. Some of the companies that, like I said, that we're holding that are down 30, 40, 50%, but the projects are still good. It's just the upside is a little less because they had to dilute at lower prices. But yes, I mean, but you don't need to have the dumb money coming in for you to make money in this sector. You just have to be a very good stock picker to do so. Because you see right now the companies that are bifurcating that have been doing really well along with the GDX and GDXJ, those companies are doing really well. And fortunately for myself and my subscribers, I do have several of those companies in my portfolio there's one that I'm very close to a triple on. And as soon as it hits that price, I'm selling 1/3 of it. And then that position will be free. Once you're sitting in a company that with just house money, it's a lot easier to hold it. And then I'll use that 1/3 of I'll use that money to invest in some other companies that I have on my watch list. Or basically there's 4 in my portfolio right now that I'm accumulating. I'll use some of the money to accumulate more, and I'll probably hold off on announcing another buy recommendation until there's another company that I'm waiting to sell also to reach my cost, because that company, the upside, I don't see as much, for whatever reason. It could be jurisdictional. It could be something management has done that I don't like. It could be the dilution now has lowered the upside potential to where I see more upside in other companies. So I'll wait for the stock to get to my cost, and then I'll put it into something else. I've done that a few times, and it's worked out well. It actually happened on a couple of take unders, basically companies that majors or mid tiers took out the junior that was de-risking a project that was a developer, and they took it out at a little less than I paid for it. So I really liked the company that took it over. I expected the stock to at least go up to my cost. It did, and then once it did, I sold it and put the money into something else. Because right now, where we're at in this cycle, this is just the beginning. I mean, we've talked about, we've yet to see retail come in here. So the last thing you want to do is give up on something that you're down big on just because it hasn't bifurcated and gone up. So a really bad mistake you can make is to lose patience and sell it, take a big loss, and then buy something that's already gone up. So, your decision to sell something should be company related, not FOMO related. It might not be the company's fault. They're doing all they can. They've got access to capital. They're de-risking a really good project. Only the retail sector hasn't come into this to this. I mean, the generalist investor hasn't come into the sector yet. So a lot of these projects are still languishing, even though they've got millions of ounces of gold in the ground. So once the sector does turn, I've had it happen to me before in the past where I gave up on something, and then I was accumulating while the sector was in a bear market, which is when you accumulate, right? And then the sector turned, and I watched things that I gave up on go up 3, 4, 5, 6 times. That's why we're in this sector, because these things can go up really fast. They go up just as fast. They go up even faster than they go down. They kind of go down like Chinese water torture, right? And then once they bottom and the sector turns, they go up really quickly to where you don't want to have to chase them. You want to have your portfolio set before the retail sector comes in and this sector turns. But the caveat to that, I think, is this time, I don't think the rising tide is going to lift all boats this time. I think it's going to be more company specific, which we've already seen.
So has the dumb money got smarter for that to happen, Dave? The dumb money's gotten smarter?
I think so. But, of course, there'll be ones that are promoted really well that maybe they might not have the goods, but they're promoted really well and they'll do well. So, I mean, that's pretty much what happened in 2010, 2011, right? I mean, the companies we should have stayed away from are the ones that went up the most. And I'm saying the companies that we should have stayed away from being bulk tonnage, low grade deposits, but those were the ones that were bought. And fortunately, during the last bull market, I was dumb money. So I was buying those companies and I did really well with several of them. And I remember going to conferences and talking to some very seasoned pros, and they're like, "No, I'm staying away from these companies early on." And then, it doesn't make sense to me. They've got all this gold in the ground, and they should do well, And part of the reason of me doing so well because I was dumb money at the time, and I was concentrating on the wrong things, which turned out to be the right things, because the majors turned out to do stupid things by buying these huge bulk tonnage, low grade deposits that needed higher gold prices to be economic. And then the bottom fell out of the sector and they're stuck with all these projects. So, and the sector is still paying for all those mistakes. I mean, they've done a great job of coming back and getting rid of a lot of that debt and shoring up their balance sheets. And now, like I said, they're paying dividends, they're doing stock buybacks, they're doing all the right things. And they're even consolidating the sector. We're seeing that, which they know they need to do to attract that generalist investor. That they need that big liquidity to attract the generalist investor. And like we've talked about, first they come, the generalists, they come into the majors, they come into the royalty plays, and then they start getting into the developers, and then the explorers, and then the early stage companies. So, we've had a couple of early stage companies do really well, but as far as the odds are concerned, I don't see it. It's a good bet to get into early stage companies just yet.
Dave, you talked about the transition from being dumb money yourself to being smarter money. And everybody I've talked to over the last 8 years, and I've seen it in myself also, one of the key steps you make is knowing when to sell, and then when you sell, take that money off the table and don't let it find its way back into something else it shouldn't, right? So, especially for newer investors listening to us, you mentioned when you had a take under, you got your money back, you redeployed it in that case. But then in another case, you're looking at a 3X and you're going to take that money off the table, aren't you? And get it out of that speculative account.
I'm sorry, I don't think I...
So when you have a 3X, part of your investment philosophy is once you get the 3X and you get that initial capital, you take that out of the speculative account so you don't lose it. That's what I'm trying to point out for newer people.
Exactly.
But then why, when you invest and you're about flat, you mentioned how you redeployed that capital again. Maybe talk through that a little, if you could.
Yeah. Well, you have to take it by a company and company basis, right? I mean, maybe when you first got into the stock, you saw this huge, like before I buy anything, they have to have at least 3 to 10 times upside as far as a junior is concerned.
Within 18 to 24 months, right? Or 18 to 36 months.
Right. Within the next 2 to 3 years, right? Maybe something's changed in that company or the jurisdiction or the deposit or the way they're de-risking it or whatever. It could be anything to where, okay, or they've had to raise money at a lower price and issue warrants. And now that 3 to 10 times the upside is maybe a double if you're lucky, or maybe 2 to 3 times. So if that's changed, then I'll basically tell my subscribers, hey, this is what's changed. I think there's better opportunities on the JMJ watch list. I have a watch list of 20 companies that I provide to my subscribers that I use, that whenever I sell a company for whatever reason to replace it, I have this watch list that I've already done a lot of due diligence on. And once it gets closer to my making that decision, I'll get with management and I'll talk to them and get more information about the companies before I do it. But anyway, basically, if I don't see that upside in the company anymore, I'll tell them, look, I'm going to wait till this stock gets to this price, which is my cost, and I'm going to sell it, and I'm going to redeploy the capital elsewhere. And I don't take the loss right now for the reason I told you before. I don't see it very cost effective right now to sell these companies that you're down on and lose money before the sector's turned, because I still like the project. Nothing's changed about the project. It's just the upside potential is not there anymore. So selling something for a loss to buy something else to take another risk to possibly get a loss doesn't make any sense right now. Does that make any sense?
I think so. And I'll point out for the newer investors that are listening, all of these nuances that you just described, you just have to experience it firsthand to really understand.
Right. And that's what my service is all about, right? You're learning along with me. You basically gain my 20 plus years of experience of having to do that, of doing this, intimately for the past over 20 years. I've learned all these lessons and I incorporate them all, and you can follow along with me and see what I'm doing and why I'm doing it in the newsletter.
And that is at juniorminerjunkie.com. Dave also has a weekly commentary on Friday evenings. He'll send you on his free email list. You can sign up there at his website as well. And the paid subscription is more of an educational and stock picking service, as Dave has mentioned. Dave, always appreciate your insights. Thanks for coming on the show and providing us your current take on the markets.
Always great talking to you. Thanks again for having me on.